So, Microsoft freezes hiring. You see the headline, and you probably think, okay, a little cost-cutting, no big deal. But that's not what I see. For me, this piece of news, it starts to shake my entire judgment on the quality of Microsoft's growth. See, the problem isn't that they're stopping growth. The real problem, the thing that worries me, is that their future growth might be getting more and more expensive to buy.
And if that's true, think about what that means. If every new dollar of growth costs more to get, that doesn't just squeeze your profit margins. No, it changes the entire DNA of the company. It changes how you, as an investor, should even think about valuing it. So yeah, this isn't just some HR update. For me, this is a blaring margin alarm.
So, what is actually going on under the hood? Why would a company that's absolutely crushing it on revenue suddenly slam the brakes on hiring in its most important divisions? On the surface, it just doesn't add up.
My first thought is this: the hiring freeze isn't about powering up some new growth initiative. It's actually the exact opposite. It's a defensive play. I'm starting to think of it as the margin defense. Okay, so here are the facts. We know Microsoft told managers in its Azure cloud unit and its North American sales teams to just stop hiring. The official reason they gave was the need to control costs and, shore up margins before the fiscal year ends. But let's be real here. This isn't about trimming a few expenses. This is a flashing red light. It's a signal that Microsoft is wrestling with a much more fundamental problem. Its growth is getting incredibly, insanely expensive. And that just leads to the million-dollar question, right? We all know the demand for AI is absolutely through the roof. Microsoft's own CFO has said demand continues to exceed available supply. So if you have customers literally lining up to give you money, why on earth are costs the big emergency?
And that gets us to the absolute heart of the problem. Because the growth is real. Oh yeah, the growth is definitely real. But it's coming at a truly staggering cost. The question isn't if they can grow anymore. The real question is, growth at what cost? And look, let's get one thing straight. There is absolutely no question that demand for AI and cloud services is explosive. That's the story everyone knows, and for good reason. It's true. But here's the other side of that story. The capital expenditure, the hard cash they're spending on data centers, on GPUs, on all that physical infrastructure, it's going vertical. It's a hockey stick. And it's not just for Microsoft, it's for all the major players. This isn't some gentle ramp-up. This is a full-blown spending arms race. Just how big is it? Well, try to wrap your head around this. Microsoft's CapEx spending is on a run rate that could easily top $100 billion for the year. $100 billion. That is an astonishing amount of money being poured into the ground just to build the foundation for AI. And you know what? This captures the market's frustration perfectly. This quote from Dan Ives at Wedbush just nails it. Investors wanted proof that all that money was generating returns. Instead, what they got was proof that the spending was accelerating while the money coming back from it was slowing down. And here's the consequence. After reporting a record quarter, we're talking over $80 billion. The stock had its worst day in years. It fell almost 10%. Why? Because the market looked right past that shiny revenue number and saw the massive ballooning cost it took to get there. The whole narrative shifted from how much they're growing to how much it costs them to grow. This brings me to what I believe is the most misunderstood part of this story. The market seems to think AI makes Microsoft stronger. I think right now, AI is first making it heavier. Just think about it this way. The old Microsoft, the one investors fell in love with, was this beautiful, high-margin software business. You build the software once, you sell it 1,000,000 times. Low capital needs, predictable cash flow. It was a money-printing machine. But the new Microsoft? It's a hybrid. It's still a high-margin software company, yes, but now it's bolted onto an incredibly capital-intensive infrastructure operator. And that means constant, heavy investment, which puts direct pressure on margins and makes the returns far less predictable. So the crucial point is, this isn't the same company anymore. It's a new kind of company with a new kind of risk. And speaking of risk, look at this. Microsoft has a massive $625 billion backlog of future contracted revenue, which sounds fantastic. But when you dive into that number, you find that roughly 45% of it is tied to commitments from just one single partner, OpenAI. A revolutionary partner for sure, but also one that has never turned a profit. That is a huge concentration risk that just didn't exist before. So this isn't just some
academic discussion about business models. It's a fundamental shift in the company's risk profile. The predictable, diversified software giant is becoming something much more dependent on these massive capital outlays, and, really, the success of a single key partner.
This all forces us to a very uncomfortable but necessary place. It means we have to start rewriting the model we use to evaluate this company.
Which begs the final question. With all these changes, the capital intensity, the margin pressure, the concentration risk, does it still make sense to value this new, heavier Microsoft with the same old tools we used before?
I don't think so. The hiring freeze isn't the story, it's the symptom. The real story is that Microsoft's growth is becoming more and more dependent on heavy capital investment. And when that happens, when growth gets this expensive, the old valuation models simply break.
The content herein represents a personal analysis of business logic and does not constitute investment advice. Market risks are inherent. Please conduct your own independent research before making any decisions.